I do have some regrets about things that I've been selling. With sells, I find it easier for some reason. I'm more confident scoring my sells than I am my buys. With my buys, I sort of want to say, well, let's see, right? I don't view them as bad buys because they're down. I don't view them as bad buys because they're up in less than 3 months or something like that. We'll see how things shape out further into the future. Interestingly, with my sales, I sort of feel more happy taking a view of them now. So I've sold three things. I've sold half my stake in Citigroup, which is unlike me. I normally tend to sell everything or nothing. I can't fully remember why I did that, but there was part of a reason for it, I think. I'll try and get to that in a second. I've sold Dowlais, which was automotive parts business from the FTSE 250 that I thought was an interesting kind of takeover target that we'll come back to. And I've sold primary health properties. And I would score myself overall at about 5.5 out of 10, which is to say there's one that was great, there's one that was terrible, and there was one that was pretty good and not better. So let's start with a great one. We're going to get to them all. Citigroup, I had a great half sell. This actually sold while we were recording an episode because I set up a limit order and said, look at this price, someone can have half of my stake. This had been moving higher on things again, like Trump potential deregulation and so on. Actually, Wall Street starting to fasten onto the idea that its cost cutting was eventually going to start having some form of effect. And its streamlining its business was looking like an encouraging sort of move. Anyway, I sold this thing at $83.50. It reached a 52-week high of $84.74, which is near the top. In fairness to me, it has now come back down to $70, which is actually quite away from where I sold it. So I pretty neatly nearly hit the top on this. That's not what necessarily makes it a good sell, but I did start to think that, look, I like Citigroup, and I think there is more to come from this in terms of growth and improvements and cost-cutting and better margins and potential for buybacks, and they have started talking about potential buybacks. The trouble is, the higher that share price goes, the less effect the buybacks have, and the dividend, especially when you factor in from my side of things withholding tax, stops becoming attractive once there's scope to do something better. When I bought it was a lot cheaper than it currently is. Even than it currently is now. I'm still well up on the shares that I have, but I'm pleased to have got rid of some of them about 20% higher than they currently are, which is quite a lot. So good job on Citigroup. Good sell, well done. Now, 0 out of 10 for selling primary health properties. I sold them at 92.9p a share. They went up to 97.1p a share, which is only 5% higher, but there were two things wrong with this. One was that I nearly went the other way and started buying shares in Assura to boost my exposure to this sector. Assura is a similar sort of REIT that deals in primary care buildings. It has a bit more of a focus on building rather than developing, but similar sort of sectors, similar sort of industry dynamics, similar sort of dividend yield at the time. And I didn't because I became concerned about Assura's rising share count. This was a stock that appeared to be pushing itself higher, but it was also growing its equity base at such a rate that I thought, this isn't actually really worth it for this kind of thing, and I will probably compound along at just north of 7 and a bit percent, which doesn't look bad when you compare it to the FTSE 100, and it does look bad when you compare it to the S&P 500. Anyway, pretty much immediately after I sold that, Assura announced it was getting sold primary health properties. Assura announced it was getting acquired by KKR, and both stocks shot up. Assura more than primary health properties, but both of them caught a big boost, which meant it was some pretty terrible timing on my part. But it's not just about timing. The main reason I'm giving myself 0 out of 10 for this is because I screwed up the share count thing. I shouldn't have been worrying about that in the same way. This is not like a tech stock-based comp that's going to rise almost indefinitely or until they start firing people or renegotiate some contracts or something like that. There are specific reasons this share count has gone higher. It's gone higher when they've done things like build or expand or acquire and so on or cut their debt down, anything that's going to make growth happen. And over time it has made growth happen, not particularly impressively. But with a starting yield of wherever I was, 7.5%, 8%, you don't really need it to necessarily. So I sort of think, that was a bad error, getting focused on a rising share count. And I sort of was thinking to myself, well, how long can you keep paying this dividend if your share count keeps growing at 15% a year or something like that? And the answer is not an awful lot longer, but it won't keep growing like that unless they find reasons to print those shares. So 0 out of 10 for selling primary health properties. It was a bad reason, a misjudgment, and I'm not above getting back into it if it falls below the price at which I sold it, which I'm now dogmatically attached to. And the last one is Dowlais, where that wasn't a great sell, but it wasn't my fault. I had this decent idea about how it was going to get bought because they were spinning part of their business, and I thought, well, that's great. They'll spin part of the business, sell that, use it to either pay down debt and be in a much stronger position, or return it to shareholders via a dividend, or even buy back their stock. To be honest, 'cause it looks pretty cheap. The trouble is, what actually happened is the entire business is being taken over, and it's being taken over by something smaller than them, which is kind of ridiculous. And worse yet, that's happening as a mostly stock deal, and the share price of the thing that's acquiring them has tanked as a result because the market's suspicious of this as well. It has made its way through antitrust, by the way. And the thing has fallen so much that it's basically back where it was before they announced the takeover deal. So they're now getting taken over at pretty much a nothing premium from what I can see of it, which is a really bad result. I sold this at 70p a share. It's now at 63p a share. I was hoping for better than that out of this. It is ahead, but I was only ahead because the stock had been rising anyway, to be honest. Not really because my buying thesis and cash generating stuff and this being undervalued really worked. So yeah, 3 sells for me, Steve. Probably 5.5 out of 10 on balance. One that's worked very nicely, one that was ridiculously stupid, and one that probably should have worked better than it actually did. But that's the way it goes sometimes in investing.
Yeah, so I mean, I started keeping a spreadsheet of all my sells to see how, because I had this sort of opinion of myself that I was a sort of 5 out of 10 seller and I should probably just stop selling. But actually, when I looked at it, I think something like 7 out of 10 sells for me have actually come out with the share price now lower than when I sold it. So I'm taking them as wins, and maybe worth something doing for you as well, Steve, just to double check that. But um, so what's precariously placed in this portfolio then, Steve? I'm looking at a Citigroup here that's gone from 1 to 10, and I always think they're quite difficult to hold when you've trimmed them like that. But I listened to your comments about Norfolk Southern, and how you've lost touch with that since the CEO's gone. So maybe precariously placed. Um, I know your cord energy at the moment isn't quite going how you thought it might. Is that precariously placed? And obviously the standout one is Southern Copper, who I think I ask you every time, what's your plan with Southern Copper for the quarter? Is there anything in here, Steve, that's on the chopping block? Is it a case of all four of them, or is it just Southern Copper?
Start of the new ISA season means that there's probably less in danger than there might be at any other time, to be honest. But you ran through your best and worst kind of performance for the quarter. I'll tell you mine for the moment. I've only got for the green on the quarter anyway, which isn't to say this is stocks into the beginning of the year, so my results might differ from these. They don't in these four cases, I think. So one is Southern Copper. DCC is up very slightly. I'm down very slightly. Games Workshop is up, and Berkshire Hathaway is up. Berkshire Hathaway is up about 15.5% in a year where the S&P 500 has gone backwards. And that actually, if it was anything other than Berkshire Hathaway, which I sold once and deeply regretted, I would be thinking this is close to fair value and other stuff is cheap. I'm not convinced I'm going to get there with that, but the more I look at Southern Copper, which is up 3.5% on my screen here since the start of the year, and like you, I did get all of that because I haven't touched that this time out. I wonder whether that's the thing I would make way for. It's tough because it's not a big part of my portfolio. It's not likely to become a big part of my portfolio because it's up so much from where I bought the thing. Like you say, it pays a ridiculous dividend. That might be the next thing that's in danger here. The other thing that's in danger, I suppose, DCC is due another look once we find out what's happening to its tech arms and healthcare arms, and there is half a chance that the result of that may well make me want to sell it, either because the share price moves or because the result is disappointing. And if the result is disappointing and the stock goes down, then it might be worth a buying look. But if the result is good, and they say, look, here comes a 25% dividend based on what we're selling these things for, I would expect that to move the stock to start off with. It really ought to move the stock. And at that point, I'm likely to take another look. Apart from that, it's difficult to see it going backwards. With Citi, I'm sort of almost as likely to buy back into it as I am to sell out of it entirely. I still have a sense that this is a stock that I'm going to regret it if I sell, because I've now sat around for this for so long waiting for it, and it's been in some ways a value trap. in that it is improving, it is getting better. However, it's taken so long to get better that if you look at what the S&P has done since then, since then, it's an underperformer, even if you get the move you want. If the S&P goes down, that might change, and the gap may well close the other way. But City, I'm so afraid to sell that. It's unbelievable. I am just sat here rooting for Jane Fraser to somehow make this work for me, basically.
And I suppose just before we do quickly roll on, Steve, maybe just a quick word on JD Weatherspoon moving into the sort of 60 million headwind. Does that change your opinion on it at all?
No. I'm reading more and more bearish takes on this, and one of two things is the case. Either I've got complacent here on thinking about this, which is possible, and I'm underestimating the impact of these costs, or I'm more right than I thought I was. So it feels like the stakes are mostly going higher on this at the moment. It's becoming a biggish part of my portfolio because every time it goes down, I find the opportunity to edge into it a little bit more. And it went down a lot after its recent results, which I thought were kind of fine. But the market's focused on costs at the moment. I'd be interested to see what kind of comes out of this. They are still guiding for a decent result, and a lot of people that own a lot of UK retail have been saying, various YouTubers saying, yes, but management is standing behind their guidance for the year. And they are right to point this out. It's also true of Weatherspoon. They are saying, we think we will do okay this year, depending on a few variables. I'm not sure I believe it in every case. In this case, I'm minded towards giving it the benefit of the doubt, and we will see. It's the kind of stock that if everything else wasn't down, and it was because it's in its own kind of it's in its own bear market, basically. Even if the indices weren't going that way, I suspect this still would. It's the kind of thing I wouldn't mind leaning into if other stuff was going up. The trouble is, I think it's more likely I find other opportunities elsewhere. I'm unlikely to get rid of it at these prices, I think. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account for Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.